All right, let's go ahead and get started today. Today is Monday, April 4th, 11 a.m. section recording on. What we're going to do today is we're going to pick up where you left off with the Nokia valuation. We're going to finish up the as-is valuation file with a few more additions today beyond what you turned in as your last assignment. And we're going to create 3 more files, which we're going to call the bull, the bear, and the target, so that you will have 4 files ready to go for this valuation, as well as future valuations, which we'll start doing on Wednesday. So after we create the 4 models today and make some adjustments to the model, that will be your pretty much final valuation model. Again, I'm not handing out a solution, so you need to create the models yourselves. But essentially on Wednesday, we'll do an in-class example of using this model on another company. As I said, it took us a couple weeks to build the first model. We'll be able to do an in-class valuation very quickly on Wednesday. And then your next graded homework assignment next Monday, a week from today, will be using these models on another company. So practice on Wednesday, do it for yourselves individually for another company. And then shortly thereafter, I'll give your teams a company and you'll do that for your next group project. Okay? So a lot of usage of the models coming up in the next couple of weeks. So where we want to start is we want to load the as-is file that we created for Nokia last week. So that will be this file. So again, just as a reminder, in class last Wednesday, we had created a valuation file that modeled out a share price of around €5. And the company at the time had a share price of 5.02 euros. So we wanted to be very, very close to the current share price. We called that an as-is. Right? And the whole idea, excuse me, and the idea here is that given these assumptions and ratios, right, we created forecasted financial statements, income statements and balance sheets, which created forecasted CFIs, they came true, which created this DCF valuation, right? And then using this DCF valuation, we had created a forecasted share price. So forecast creates the cash flows, creates the share price. And we said that's what we wanted to match very closely. Well, the process of an as-is works backwards. We know the share price in the real world. So what assumptions reasonably create that share price? That's the whole point of an as-is valuation. And so back to the assumptions. We kind of knew the WACC, so we used the WACC at the time. We had a pretty good idea for what the revenue and EBITDA was going to be in the next 4 years from the consensus. And so we went to the ratios, we said, okay, these 3 items in gray are the 3 most important part of the forecast because they represent gross cash flow. Because when we do a forecast for operating value, it's the free cash flow is the primary driver because the non-operating values don't usually change that much, right? Excess cash, well, cash is cash. Non-operating assets don't change that much. So really the real value that's going to change in our model is going to be the operating value, first 5 years and the continuing value. Okay, so forecasting free cash flow, 2 parts to it. Gross cash flow, these are the 3 drivers of gross cash flow, and these are the drivers of gross investment. So here's the point, because the balance sheet is set up in this model to say everything here is a percentage of sales, then as revenue grows, the balance sheet grows. And the difference between the balance sheets creates gross investment. So essentially the model, excuse me, is actually set up to auto forecast gross investment. And as long as the productivity doesn't really change, which is true for most companies, then we don't really have to worry about the model auto forecasting the balance sheet. So that's what's happening here, right? In terms of the gross investment. Where we do need to spend most of our time is right here, which is gross cash flow. This is the 80-20 rule, or even a 90-10 rule of what we need to do in terms of forecasting. So forecasting growth rate, EBITDA, and tax rate, right? And essentially the G that comes out of that. So back to our as is, we put in a reasonable tax rate. That was pretty reasonable. As I said, based on these assumptions for the 4 years, we knew the growth and the EBITDA margin for the 4 years. So really all it left us down to is these numbers, the growth and EBITDA in the out years. And again, I'm going to hide a few columns just so you can see the labels here. So it's these growth rates and EBITDAs and the G in perpetuity. That's what's left that's going to be most important in our model. And we just kind of plugged in some numbers very quickly that got to the €5 share price. But how do we know that this operating profit is a reasonable operating profit in the out years, right? Again, we just kind of plugged and chugged our way through. So here's where we're going to pick up and make some additions today based on some additional content. So a preview of what's coming up in the next section of the class on multiples is multiples are just key value drivers rearranged. Okay? So pulling from the textbook, I'm going to pull two things. One, in the multiple section of the class, we're going to show you how if you take the key value driver equation here and rearrange it, you get, for example, the enterprise value to EBIT multiple. Okay. And then we're going to show you that the enterprise value to revenue multiple is also the key value drivers rearranged. Okay. And the enterprise value to revenue or enterprise value to sales multiple is the margin times enterprise value to EBIT. Okay. So we got a couple multiples that we know how the math works. Okay. As a matter of fact, this formula has already been put into our model. Here, took a screenshot of it and I put it into our assumptions tab already. Okay. And what it tells us is that if I know the enterprise value to sales multiple and I know the margin, I can solve for the enterprise value to EBIT. Or if I know the enterprise value to EBIT and I know the enterprise value to revenue, I can solve for the margin. So essentially that's what we're about to do. Okay. If I know the EV to sales and EV to EBIT divide, that gets me my margin in perpetuity, which by the way, is that number, M10. So M10 can be solved for with this equation because that's the margin in M10. Okay. So hiding in plain sight in the multiples of the company is the long-term margin of the business. Now, one other thing, between Wednesday and today, Nokia's data has changed. So I'm going to actually share my desktop so I can jump back and forth a little bit more easily. But this data that we put in was based on what happened on Wednesday. And if I go to Nokia today, two things. One, you notice the share price is different. Now 5.11 euros. Last week, it was 5.02 euros. And the other thing is, this analyst from Nordea Bank uploaded a new model this morning. And if I go to the EEO, you'll notice, because the EEO is a sum of what the analyst guesses are, the average of the guesses, that these numbers have changed slightly. So for example, revenue is now 23,234 in 2022. Here is 23,235. It's gone down by $1 million, right? So these numbers have slightly changed even over the last 5 days. In addition, the multiples have changed because these multiples down here are a function of the current share price. So for example, current share price is 5.11 euros. So if I take 5.11 euros divided by 2023 EPS, well, that's how you get to the price to earnings ratio. 5.11 divided by 2024 EPS, that's that PE. This also creates a concept of an enterprise value. Enterprise value to EBIT is the 23 EV to EBIT multiple. So these multiples are based on that share price. So every time the share price changes, the multiples change. So it's very important that we take all these screenshots at the same time, because we don't, then we're going to be out of sync. So I can't have multiples from today and share price from last week. But otherwise, Nokia has also changed. So what I'm going to do today is we're going to update our model to right now, and we're going to finish up the valuation based on today. Okay, which means I need 3 new screenshots. Right. So the first screenshot is right here. I need the EEO from today. So Nokia EEO April 4th, and this is section 301. I'm also going to need a DES from today. Nokia DES April 4th, section 301. And I'm going to need a WACC from today. And you'll notice the WACC has changed. It's 9.3%. Interestingly, save Nokia WACC April 4th, section 301. So it's 9.3% right now. If I go back to the last class, oh, it was in the other file. File for downloads. No. Sorry, a little mouse trouble today. File, new finder, downloads. What I wanted to show you is in the last class, section 201, we did the screenshot earlier today, the WACC was 9.2. Hour and a half later, 9.3. That's the dynamic nature of the real world. Like literally the data is changing by the minute. That's why it is so important that you do screenshots, 1 at the same time, and 2, you're going to have to turn them in for your assignments, because when you do your assignment, the data changes, and therefore the numbers will change slightly. So we need to know what data you used at the time of your assignment. Okay, and no 2 should be the same. So back to Nokia, taking these screenshots with the most current data, I need to update my model. So first, WACC is now 9.3. So go here to our WACC. Last week it was 8.1. It's gone up a lot in a week. 9.3. Okay. Next, what we need to change is the current share price. Current share price is now 5.11 euros. So 5.11 euros. Okay. And finally, the EEO had changed. To these numbers. So 23,234. So 23,234. 23,848. Eight. 23,314. And 23,911. Change the most. All right, what happened to EBITDA? 35.29 went down by 2 million. Second year out, it went to 3910, went down by 1 million. $4,085. And 43.42. That one didn't change. So the margins estimates changed slightly. And again, why did that change? Because this analyst uploaded a new model this morning with a new forecast. And the forecast is the average of all these guesses from all these analysts. So with new data, forecast updates. That's why these screens have changed. WAC's also changing as interest rates have been dramatically going up in the last couple of weeks, result of the war. Right, so that's playing itself through the marketplace. People's risk profiles are now changing because of that as well, very, very quickly. By the way, I don't know if you noticed the mortgage market has gone up dramatically. Mortgage rates used to be in the 3s. Now they're almost 5% for mortgages. That's in like the last 30 days. Okay, it's going to have a devastating effect in the housing market coming up, but for a different time. So back to Nokia here. We need to update those data points, right? Now, the one thing that probably hasn't changed in the last 5 days is the estimate for the tax rate. So here, I'm pretty good on the tax rate, okay? But I've basically changed the revenue growth rate and the margins. We've changed the WACC, and our forecasted share price now has gone down to 4.67, right? And I want to get, again, close to 511 today, okay? So file, save as. This is our new as is for April 4th. This is section 301. Okay, so these are the changes that you should be making to follow along with me. Make sure you get this. So here's what we need to do. This is what's left right here, growth in EBITDA and G, right? So let's come back to the multiples. I need to make sure that I get a reasonable EBITDA margin, particularly here, because this is the perpetuity one. It's going to be the most impactful one. Well, I know the formula is right here. Enterprise value to revenue divided by enterprise value to EBIT is that perpetuity margin. So back to the EEO screen. Make sure it's still 511. Okay, so these multiples are changed. Excuse me. So these are the forward multiples based on the forward earnings forecast. This is this is actual nomenclature, forward year 1 estimate, forward year 2, forward year 3, forward year 4. As the book talks about, forward year 2 or further, these are the clean forecast years. So for example, 2022 for Nokia includes 3 months of actual data and 9 months of forecast data. This is 12 months of forecast data. So starting with the first 12-month forecast year, these are more normalized. These are the ones we tend to use in valuation. So these are the forward years that matter more, 23, 24. Okay. So EV to sales in 2023 is right now is 1.06. EV to sales in 2024 is 1.04. EV to EBIT in 2023. It's 8.38 followed by 7.79. Okay. So what we're going to do is adding to our model. I'm going to put in my forecast EV to revenue. And I'm going to put in my forecast EV to EBIT. And I'm going to do it for 23 and 24. Make those cells yellow. I'm going to type them in. So right now, based on that current share price, EV to sales is 1.06 and 1.04. And EV to revenue for EV to EBIT is 8.38 and 7.79. 7.79. So that's the estimated margin is the EV to revenue divided by the EV to EBIT. That's that formula over on the right. So basically 12.6% and 13.4. So what I know is based on the trading multiples that somewhere between 12.6 and 13.4 is what these analysts have to be using for their perpetuity EBIT margins. That's the only way that those trading multiples make sense. Okay, that's what the math tells me. All right. So back to our ratios. We had stuck in 8.3%. We are clearly below what the math says the range has to be based on the trading multiples. So that's the point. I need this number to be somewhere between 12.6 and 13.4. Okay. Now, given the share price valuation we've already kind of done, I think 12.6 is probably a better number for perpetuity than 13.4 for long-term EBIT margin, because 13.4 is well beyond anything that they've done historically. So I think 12.6 sounds more reasonable to me. So I want this number to be 12.6. But here's the problem. It's a white cell. It's a formula. I can't directly type something into that cell because it will break the model. Okay. So how did this white cell M9 get calculated? M9 is M7 minus M8. M7 is EBITDA. M8 is depreciation. So this minus this equals that. So the way that I change this to 12.6 is I'm going to change the EBITDA. Okay. So basically we're going to reforecast EBITDA that gets the operating income to equal this number in perpetuity. So to get to 12.6 from 8.3, I need to add 4.3. So adding 4.3 to EBITDA basically makes this 17.5. So by changing the EBITDA here, it changes the operating income here, which by the way, changes the share price down there. But this is a more realistic operating income for 2027, the perpetuity period, than the number that we previously had for our last assignment. Questions? I know there's a lot.
Can you go back to the assumption screen just so I can see it real quick?
Sure.
Thank you.
So those were the two forward trading multiples over here, 23 and 24, forward years. And based on those trading multiples, that's what the margin would have to be, just based on that equation over there. I picked the 23 one just because I thought this as a range looked higher than the historical range. So I thought this was probably a better number in the range, but we could have been somewhere in this range because the multiples say they had to be somewhere in this range. I picked 12.6. So therefore, create that to get 12.6. Now, here's the thing. Previously, we had a forecast for 2026, which I had done smoothing. So I'm going to smooth this to this. So I'm just going to move this halfway between this and this, just to smooth it. So 18.2, call it 17.8 to get to 17.5. It's not going to matter that much, but I don't want it to like do that. I want to go more like that. All right, everybody with me so far? So if I've done my EBITDAs, now what's left is my growth rate and my G. So the question is, I want to do revenue growth rate last. The G is the next one I want to look at. So what is a reasonable G? Well, that's where this equation comes in. EV to EBIT. So I'm just going to screenshot this. So I have it. Put that over here in the model. All right. So here's the point. EV to EBIT is 1 minus the tax rate times 1 minus the G over ROIC divided by WACC minus G. So here's the point. I have a pretty good idea what the EV to EBIT is. It's right there. I have a pretty good idea what the tax rate's going to be. It is right there in perpetuity. I'm pretty confident about that tax rate. I have a pretty good idea what the WACC is. It's right there. Not going to change. And I have a pretty good idea what my perpetuity ROIC is going to be. So I can solve for a G that basically gets this enterprise value to EBIT to basically match what's in the real world. Okay, so that's what we're about to do. So I'm going to put in a forecast G. And then what I'm going to do is I'm going to create a model EV to EBIT for 2023, make yellow, such that this EV to EBIT will match that EV to EBIT. Okay, based on solving for a G. Okay, so in cell C22, I'm going to put in this equation. Okay, so for cell C22 equals left parentheses 1 minus the tax rate. Well, the tax rate is off of ratios. M is our perpetuity period. Tax rate is 10, so M10. Right parentheses. Say that for the time being. All right, so then what I'm going to do here is I'm going to multiply that by left parentheses, just following this equation over here, 1 minus the G. I'm going to use this G, C21, divided by the ROIC, which is here in perpetuity, B6, right parentheses. I'm going to take all of that, left parentheses, right parentheses, and I'm going to divide that by left parentheses, the WACC, which is right here, B4, minus the G, right here, C21, right parentheses, enter. And I'll make that 2 decimal places. So here's the point. With no growth in that equation, I would get, based on all the assumptions in my model today, an 8.06 EV to EBIT. Well, in the real world, for this year, it's 8.38. So how do I get them to match? How do I get this to be 8.38? Clearly, I need to have a positive G. So the idea of having a 0 G, which is where it is right now, this is 0%, wouldn't get me, with the assumptions of my model, to an 8.38 EV to EBIT. So what would I need to change? Well, I can either iterate or I can solve. So in Excel, data, what if, it's called goal seek. This is the solver function. So what I'm going to do is I want to set cell C22 to equal what I'm looking for, the 8.38. And I want Excel to kind of iterate by changing C21 to do it. So basically, it's going to solve for a G of 0.54%. So at a 0.54% G, these match. 8.38 model, using that academic forecast. This is the real world. They now match.
Professor, could you go over how you did the what if analysis, please?
The solver? You're talking about
Yes.
the solver?
Yes.
Okay. So under data, what if, it's called goal seek. Okay. And goal seek might be in a slightly different place if you're in Windows, but you want to get the goal seek. And so what goal seek does is he says, look, if you know the cell that you're trying to solve for, so I'm trying to solve for C22, and I know what number I'm trying to get to, so I'm trying to get to 8.38, then what cell do I change? So Excel will just keep changing the cell that you're trying to do until it matches that number. So I want to keep changing cell C21 until I get the value in C22 of 8.38. Hit OK. And that's the 0.54%. Now I could have also just done this iteratively. I could have said, okay, what if this was 0.5%? Oh, that's 8.36. What if this was 0.6%? Oh, it's 8.42. So it has to be somewhere in the middle. Okay. So I could have just keep changing the number until I got there. That's the one way to do it. But as I said, the other way to do it is to use goal seek, to say, no, what I want to do is I want to set this to be the 8.38. So I don't have to keep changing. Set that cell to 8.38 by having Excel do the iteration on C21. And that was the 0.54%.
Do you know why when I do goal seeking, it gives me a different percentage than you?
If your numbers are different anywhere in your model, it's not going to give you the same percentage. So like if you didn't change these numbers over here, you're going to have a different share price and a different enterprise value. As a matter of fact, that's the other part I'm about to show you. So here's the point. Now that this is 0.54, I'm going to come here to my G. I'm going to make that 0.54. But here's what I want you to see. Watch what happens to the ROIC. 25.5, 0.54%. Actually, it didn't change that much. But now I have a G in perpetuity, 0.54%. And that did change the share price to 5.71. So the share price is now a little bit higher because I added the extra G. But that's what the market is doing. The market is using a G closer to that because that's what the trading multiples tell me they have to be using. Okay, so here's the point. I still need to get this to be 511. I put in a more reasonable EBITDA. I put in a more reasonable G. Now what's left? Put in the growth rate that gets them to match. So if I start putting in the growth rate, and the one that's going to matter more is the 2027 growth rate, because that's the perpetuity period, it's not going to be shrinking 2%. The market thinks that Nokia is going to be a lot smaller than just shrinking 1.7% in the perpetuity period. So what if they were 10% smaller? What if they were 20% smaller? And what if this was more smooth? So this was 6% down. Now I'm much closer to the current share price. So something closer to this is a more reasonable as is than what you turned in for your last assignment. And the reason I say it's more reasonable is we put in a operating margin that was more closely aligned with what the multiple said it had to be. And we put in a G that was much more closely aligned with what the multiple said it had to be. And that got us to solving for a growth rate. So here's what we know. By doing the as is, Nokia is expected to be a smaller firm in the future. That's what the market is trading them at today. And they're going to maintain their margins as a smaller firm, but they're going to be about 80% of the size they are today. That's what the market is saying about Nokia. Now, this is not whether we agree with this. That's the target valuation that we're going to do next. But this is about what the data and the formulas say the cash flows have to be to represent that current share price. This is a more true as is than the one you did this morning. And these are the things that you have to add to your model to be able to do what we just did. Questions?
Should I worry, like, so when we did the goal seek for the forecast G, I still have the same share price and everything, and the model EV to EBIT to 8.45, but it's just giving me like a negative 1%. Should I worry about that?
Yes, because that shouldn't be right. You should have something that looks a lot like this. Because you could just type in a G and then you should be able to get these models to equal each other, this and this. So it's just, my guess is you either have a wrong formula there, which is very possible. So leave that up for a second. Or you just have something different assumptions in your model. Because otherwise the math has to be the same.
Could you leave that up for like 30 seconds just so I can copy
sure.
it? Thank you.
All right. So one other thing to be aware of while he's asking to copy that formula is the iterative nature of what we are doing. So remember when I said, remember the ROIC? 30 seconds ago, that ROIC was like 25%. Now it's down to 21%. How did that change? 30 seconds ago, these two matched. Now they don't. What happened? When we put in a 20% drop in revenue growth in 2027, it took the income, the revenue, and the EBITDA down, right? And then when the model created the share price, that's how we got the lower share price, because we had less cash flow. Well, if you have less income and a similar amount of balance sheet, you have lower ROIC. So when the model recalculated everything with the lower revenue, it got a different share price. That's why this model EBIT changed, because the ROIC is also lower in perpetuity. Now, they're still pretty close. 8.34 and 8.38 are pretty close. But this is the circularity of the model, because basically our G and our growth creates an ROIC, which creates a multiple. And as we change the multiple and change the G and the ROIC, it changes the multiple. They go backwards because it changes the ROIC. And so anytime any of these change, the others change. This is why it's circular. There is a circularity here. Okay. And so here's the point. I'm not asking us to iterate any further, because I don't think that there's much of a difference between 8.34 and 8.38. So going through this process once without being circular, because otherwise it'll just take you forever to get them to be exact, to get 8.34 and 8.38 to match. But this is close enough that I'm not worried about the matching, because that's the point. I know that my G needs to be somewhere around 0.5%. That's what I'm trying to get to. I'm trying to get to a more reasonable G than just, I think it's about this. That's what we did last week. And that's not a good method. So working backwards from the multiples, I'm closer to the G, and I'm much more confident now in my model because of that. That's what I want you to understand, and that's what I want you to do. Okay, any other questions?
Quick question about the G.
Mhm.
Is this G being rated as the growth rate of Nokia, or the growth rate of the economy?
No, this is Nokia. This is Nokia's G in perpetuity. So this is the G here in this equation. That's that G. It's for Nokia's EV to EBIT. So it's Nokia's G. All right. Or whatever company this becomes, it's that company's G. It's a reusable model, but this is that G. All right. So now we have reconfirmed our as is based on today's price, based on today's multiples. That's the G. That's a continuing value ROIC. That's our growth rate. That's our EBITDA margin. That's our tax rate. We didn't change the balance sheet. So I want to save that file. And this is my now as is. So what we want to do next is we want to create 3 more files from this one. What we're going to call the bull, the bear, and the target. So to give you an appreciation for this, I'm going to go back to Bloomberg. So we're doing the exact same thing the analysts are doing. So A and R. So what the analysts are doing is they have spreadsheets just like ours, which are forecasting the cash flows. But the difference is when we get to the target, it's now an opinion. What do I think the share price will be in the future? And specifically, the target is 12 months into the future. So where do I think Nokia's share price is going to be 12 months from today? Okay. So this is the concept of intrinsic value. Based on the information I have and the cash flows that information represents, this is what their share price should be. As the information comes out, company share price should move towards that amount. Okay. Now this is how the analysts can say that they could be wrong, because we're dealing with a year in the future. So I might be wrong, but hey, it's the future, so you can't sue me, right? But nonetheless, this is my guess of what I think the share price is going to be 12 months from today. That's the idea of a 12-month target share price. That's what we're going to do next, because that then creates your buy, sell, hold opinion. This is opinion. That is fact. Okay, so the as is deals with the fact and says what formulas lead to that fact, educated guesses. target is now I can say, I don't necessarily agree with what I just put into this model. I can put in assumptions that I believe are more realistic, come up with a new price. That's your target. But before you do the target, there's two files you do first. We call it the bull and the bear. Okay, think about this. If I'm selling my research to a buy-side institution, a buy-side institution is thinking about portfolios. When I think about a portfolio, I optimize my portfolio based on risk. Risk is standard deviations, the volatility of a stock. Okay, so what I care about is not just the target price, I care about the volatility. Tell me about the high, which we're going to call the bull, and the low of the range of where the stock can go in the next 12 months. All right, so I'm going to draw this. So if I were to draw this page down here. This is kind of price over time. Sorry, I'm having trouble with my mouse. It should be a vertical axis. But in any event, this is today Nokia, right? And this is the as is. That's Nokia's price today. Okay. 12 months in the future, the price could go up. This is what we're going to call the bull. That's how high it could go in the next 12 months if everything goes right. This is the bear, file number 3. This is the bottom of the range, but that's how low Nokia could go in the next 12 months if everything goes wrong. Okay, so I create my scenarios. I got my best case scenario, the bull. I got my worst case scenario, the bear, and the rationale for each, including links to the real world. Somewhere in this range is scenario number 4, which is called the target. That target share price will be between the bull and the bear. And I could choose a target anywhere within this range. Okay, doesn't have to be the midpoint, but that's the point. That's model number 4. And by the way, by definition, the target has to be between the bull and the bear. If you submit a target outside the bull and the bear, first it will cause some laughter amongst the people grading you because we're like, haha, they did a target outside the bull and the bear, but it'll also give you a very, very bad grade because by definition, the target has to be between the bull and the bear. Okay, so that's the point. We're now going to create these 3 models, but before we create the target, we got to establish the range. What's the bull? What's the bear? Okay. Questions about that? All right, so I'm going to take my as is, file I'm in right now, that I finished, with an 5.11 share price, or actually we're at 5 point, yeah, exactly matched it, 5.11 share price. That's my as is. And I'm going to go file, save as, and then I'm going to make this my bull. So I'm going to save my bull file for my as is. So now I put on my rose colored glasses and I say, okay, for Nokia, what could go right over the next 12 months? Let me put in those scenarios. All right, so what are those scenarios? Well, one of the things that could go right for Nokia is, and again, this is why it's very important to do the EIC before and the historical analysis before you do the valuation. But that's the idea, is that, all right, so I know Nokia, it's a lot about what happens with 5G. And so in the current scenario, it looks like Nokia is going to really struggle with 5G against Huawei, and particularly the adoption in a lot of countries. And so let's say that Nokia doesn't struggle, and it's actually much more successful, competitive in the rollout of 5G. And the carriers embrace it much more so than they have today. In addition, Nokia is struggling with their previous Alcatel-Lucent acquisition at transitioning to the cloud in the telco business. And so let's say that their software business in the cloud is actually far more successful and that they actually do better in the transition to cloud-based services, and they don't shrink as much as currently expected. So I'm not saying that Nokia is going to see boom times ahead, but what if their revenue growth rate is relatively flat to, instead of shrinking, they just maintain their size, okay, at 1% a year. growth. Well, now I'm up to a share price of 5.86 for the reasons that I just articulated, because that's the point. In your grading, in your papers, in your PowerPoints, not only must you explain the changes in the key assumptions, but you also have to explain why and just link it to the real world. If you don't link it to the real world, I'm not going to give you credit. You can't just say, I'll just say 1% and see what the heck happens. No, you have to explain how you got to the 1% assumption. Okay. And these are the key assumptions that you're going to change. Potentially revenue growth rate, potentially EBITDA, potentially tax rate, potentially G primarily. Now you can change anything, but as I said, that was the 80-20 of the valuation. I also don't think the long-term growth prospects in Nokia are going to change that much. I think 0.5% per year in the long term is fairly reasonable. I just think that they're going to maintain their size. They're not going to shrink. Right. I also think that they're going to maintain their margins. In fact, they might even maintain better margins given that scenario than they're getting, not higher than they were here, but 18.2% might be where they stay long term. So make this 18.2 and 18.2. That gets me to 6.04 euros for their share price. I don't think the tax rate's going to change, so I'm going to leave that alone. We use one WACC over the valuation, so I'm not going to change the WACC. So basically, I think Nokia in a bull scenario could be worth as much as 6.04 euros in the next 12 months. Save file. And articulated reasons. I'm going to close this file. I'm going to reopen my as is with the 511 share price. And I'm going to recreate another version, save as, and I'm going to call this my Nokia Bear. So now I basically have my pessimistic hat on. What could go wrong with Nokia? More wrong than it's already apparently going, that could make the stock price go lower in the next 12 months. What would that scenario look like? Right? Well, one of the things that I think could go wrong in the next 12 months involves the war in Ukraine. Right? So we now see global sanctions. And particularly even today with the bad news that's coming out of Ukraine, sanctions could be getting even worse. And the sanctions increasingly might not only be applied to Russia, but in a worst case scenario, might it be applied to China, India, and other countries as the world tries to put export control pressure on technologies they don't want to get to Russia or any companies that might help Russia. So we could have actually established much more worse trade environment going forward, and companies like Nokia could clearly get caught up in that. And so for the next few years, Nokia, which is trying to roll out global 5G, basically could really be hurt against companies like Huawei and really be hurt in some of those Asian countries that are more neutral right now to Russia. And so those export controls could actually hurt Nokia even more. So what I'm going to do is I'm going to come to the assumptions. I'm going to say, in that scenario, I could see Nokia losing 10% of its sales. And so it may not recover by the perpetuity period. So I'll put that at 21 billion and 22 billion, so that they're smaller by the perpetuity period than the current analysts expect. And I think that the margins are also going to slip, that their margins could easily fall to 1.5 billion of EBITDA, 2 billion of EBITDA, and then 2.5 billion of EBITDA. Okay. So as I said, the analysts, which are not pricing out a worst case scenario for these trade sanctions, I'm saying if the trade sanctions actually come into play, this is the type of thing that those could change their margins and their revenue to over the next few years, right? I also think that that would temper their long-term growth rate to 0. And I'm not saying that they're going to shrink any further in the long term. That's already another 20% cut on top of this, but it could affect their margins as well long term. They won't get as high as they did 17.5 in the as is, and they look more like they did in 21, 22 long term. And this gets closer to 15%. Okay. Again, I'll just smooth this. This goes from 13 to 15. But notice my bear scenario now puts a share price closer to 381. Okay. So file, save, bear. All right. So I've established my range. I think in a worst case scenario in the next 12 months, Nokia could trade as low as 381. In a best case scenario in the next 12 months, if none of this happens and they get the other things I talked about, they could trade for 6.08. I've established my range. Now, the final question, where in that range do I think Nokia is going to actually show up? I go back to my as is, 511, file, save as, and then I create what's called the target. The target is now my opinion. So now what do I think? Where do I really think that they're going to end up in the next 12 months? Yes.
For the bowl one that we did, was it 6.08 or 6.04? I got 6.04.
I have short-term memory loss sometimes, so let me look this up. Here is my bowl. The bowl was 6.04. Thank you.
Okay,
6.04. A lot of numbers thrown around. 6.04 in the high end. And at this point, I'm not going to ask you to turn in the bull, the bear, and the target for Nokia, but I want you to do this just so that if your numbers are approximate, because I'm making a lot of changes, but you're going to need to do these 4 files for an in-class example we're going to do on Wednesday. And then you're going to use these 4 files for your next assignment, which you're going to have to do on another company for next Monday. Okay. So the process is what I'm more interested in at this point. Your numbers are slightly different because you didn't hit every number in the bull and the bear. That's okay. But nonetheless, if you are trying to follow along, the most important part that you need to do is get this structure in right. Because if you don't have that structure in right, then you won't be able to recreate all these models going forward. So back to this target, where in the range do I think they're going to be? Now I'm just putting in my opinion. My personal opinion is I actually think Nokia will do better than they are today. Okay, so get rid of my bull, but not quite as good as the bull. So here's the point. I think the Nokia might shrink, but I think that 5% is more reasonable than 20% for Nokia. I also think that their margins are going to stay pretty high, but not as high as they did in 2025. I think they're going to be closer to their 2024 margins. So I'm going to make that 16.8%, right? And so the reason why 16.8, that I think that they're going to do better in the future than the as is what I started to say in my bowl. I think that we are underestimating Nokia's ability to sell their 5G worldwide to the telcos. And I think that that is an upside opportunity for Nokia. I don't think that the trade war is going to affect them dramatically into the future. Okay. And so therefore it's going to be more of a blip on their long-term sales. And more importantly, I think they will have some success at converting their business over to the cloud. It's not going to allow them to grow, but at least it'll manage to stabilize and keep where they are in the transition. And so with that level of growth, that level of sales, I'm not going to change the tax rate. I'm not going to change the G. I still think their long-term is still about the same at about 0.5% a year. That gets me to a share price of 537 euros. Okay. Now, here's the thing. If my forecasted target share price of 5.37 is within 10% of the current share price, that is called a hold. Okay. So 10% of 511 is 51. So 560, anything between 511 and 560 is a hold. By the way, 10% below 511 is 460 is a hold. So anywhere between 460 and 560 is a hold. Plus or minus 10% of the current share price is a hold. I'm saying 5.37. I am calling Nokia a hold. And the idea of plus or minus 10% of the current share price is the idea it's a trading range. Okay. So the stock price is going to be bouncy. It's going to bounce up and down around this range. And therefore, I'm not going to advocate that you buy or sell your stock because it's trading in a trading range. I think 5.37 is in the trading range. Therefore, hold. If I think the intrinsic value is more than 10%, more than 560, then if that's my final target, I would call Nokia a buy. If I think Nokia is less than 10% of the current share price, goes down more than 10%, so less than 90% really, so below 460-ish, then that is a sell. Okay. But anywhere plus or minus 10% of the current share price, that is a hold. And that's the way that we're going to create our buy, sell, hold opinions. Questions about any of that? And why Nokia in my model is a hold. And again, you can disagree. You could actually put in assumptions that tell me that you think Nokia is a sell in the next 12 months. And I won't grade you down, or the TAs won't grade you down just because you said it was a sell, as long as you can support it with reasonable assumptions that are backed up by real world data and a real world story, because that's the key. It's not just about plugging and chugging. It's about, can you explain your assumptions? That's just as important to the institutions in the real world as the academic, could you solve for an equation? And so we have to do both in this class as part of your assignments. Questions, comments, concerns, crippling fears about any of this?
I have a question about the when we explain the bull and the bear, where do we write out the, like, do you want to write it in the Excel?
So what your assignment's going to say is turn in your 4 Excel models with a minimum 500 word paper. So it's in the minimum 500 word paper that you're going to write out all the assumptions for all 4 models. What assumptions did you do for the as is? Why'd you use those assumptions? That's the easy one. What assumptions did you do for your bull and your bear? Why'd you change them from the as is? This is where the real world context comes in. What assumptions did you settle on for your target? Why'd you choose those versus the others? Again, what in the real world makes you believe it's going to be there? This is why I say you would have already done your EIC, which means you would have gone to BICO and you would have read what's going on here. So I didn't just make stuff up about Nokia. I kind of have a sense by what's going on over here with the related research and reading through the BICO of what's going on in the industry. Okay, this is again back to what you've done when you do your EIC and your historical analysis. You got to know something about the companies if you're going to do the valuation. It's not just a mathematical exercise, right? So we'd want to look at the industry data. Here's the industry primer on what's going on in the telco supply industry, right? Because these are global networking companies. So here's what's going on at the industry level. So I would have done my industry research and I would have seen what's going on, even with the 5 forces, for example, when I do Nokia. Okay, you can't do these things in a vacuum. Otherwise, you're not going to really have very good valuations. Assumptions on the target. So this is the target. This is the assumptions. All right, any other questions about any of this? All right, so then save these 4 files. And as I said, in class on Wednesday, we are going to take these files, particularly this as is, and during class, I will give you a different company and we'll talk through the process of how we update the model for a brand new company. And then we'll do a valuation in class together of a new company. And then I'll give you at the end of class, the company that you're going to do for homework 8. And that'll be your next graded homework assignment, due 1 week from today. Okay. And then shortly thereafter, I will give you the group project company, which one of your members from your group can use the model with the rest of the group to basically do the group project. The only difference is your homework 8 will be a paper as well as the 4 Excel models. The group case will be the 4 models and a 10-minute PowerPoint presentation going over the same stuff. Okay. So that's what's coming up on the valuation assignments. Other than that, save your models. We'll see everybody on Wednesday and we'll pick up from here. Have a good day.
Professor,
Yes.
just want to confirm, did you say the group, the homework 8 will be an essay paper instead of our Excel model?
So you're going to, for the next homework, you're going to have to basically do a company.
Yeah.
And then all the 4 Excel files with the company, but then you have to write in the paper that you'll turn in with the Excel files, the write-up of your assumptions.
Got you.
Just as I was just articulating those assumptions, you're going to write them down because otherwise that's how we're going to grade your assumptions.
Right.
So we'll
Got
grade both the model and the assumptions.
it. Thank you.
No problem. Thank you. Have a good day.